Welcome to the latest Ticker TV interview. I'm Donald Leggatt, and I'm joined today by Alex Scanlon, MD and CEO at Barton Gold, ticker at BGD, a profitable ASX-listed gold and silver developer with projects at Tunkillia and Tarcoola, and a working mill at Central Gawler, all in central South Australia, and all with fly-in access from Adelaide, the nearest city. Alex is also something of an expert in physical gold, and with the gold price at an all-time high, we will certainly be asking him for his gold price views. First, though, to Barton Gold, who've just released a scoping study, we hear, where Alex and the team started to acquire assets 5 years ago. Welcome, Alex. It's really good to catch up with you.
Thank you, Donald. It's good to be here.
You run a profitable ASX-listed gold and silver mining development company. So if you could give us a brief overview of Barton Gold and the Barton story. It's fascinating.
Yeah, look, so the high-level summary for us is that we are a pure-play gold and silver as a byproduct credit developer focused on South Australia. So South Australia is a very interesting region geologically. It's the home of the Gawler Craton, which most famously hosts BHP's Olympic Dam deposit. And that Olympic Dam deposit project is part of a chain of iron oxide, copper gold projects. So BHP now owns all three of those. And the same basin that hosts those three copper gold deposits trends to the west. And as it becomes shallower to the west, it becomes goldy. So it goes from being deep and coppery to shallow and goldy. And this is something that we recognized as sort of a forgotten jurisdiction about 7 or 8 years ago, and we quietly went about consolidating all of the main historical assets there. We also took control of the only gold mill in the region, and the idea was to step back, build up a much larger platform, essentially create a viable pathway to a distance target, or let's say a target of consequence in terms of large scale production. And then start systematically unlocking all of this by leveraging that mill. So we're aiming not for 50,000 ounces per annum, but 150,000 ounces per annum production. And we are just now in the final stages of sort of crystallizing the commercial development pathways for stage one using the existing mill, and stage two, which will be our larger scale expansion Tunkillia project.
Which takes us very nicely to the scoping study, which has literally just been announced. So perhaps if you run us through the highlights of the Tunkillia scoping study for us, please, Alex.
Yeah, look, so last year we published an initial scoping study. This was in July of 2024. And the idea was that we had scaled this project very quickly and very efficiently in terms of exploration and discovery. So we had grown it to about 1.5 million ounces at that time. And so we wanted to test the premise, which was our theory that this could operate and produce gold very efficiently at scale. So we are big fans of bulk open pit mining. You can achieve low unit costs and therefore high unit margins. So we ran an initial test at the time, and what that gave us was a very competitive gold producing asset at around $2,000 per ounce all-in sustaining cost Australian, or about 1,250 US. And so we had done that on the basis of some pretty conservative assumptions around the hardness of the material. We assumed it was much, much harder than it really is. We also assumed a very inefficient crushing circuit. And so we've done about 10 more studies between then and now, and we've just published an optimized scoping study, which in effect has dramatically reduced the power consumption required to turn rock into dust, so to speak. So we've achieved about 35% power savings in our crushing and grinding circuit. We have been able to then expand the size of the open pit. So take some of these savings, push them out into a broader pit, extend the life of mine, and extend the overall production. We've been able to reduce the capital cost estimate. So the cost of building the process and non-process infrastructure, the cost of the pre-strip. We've also been able to optimize the mining schedule. So all of this has come together into a much, much tighter project model, which is both fully built from the capital and operating cost estimation standpoint. So this is not a factored model. We have a full mechanical equipment list. We have a full drive list. We have very, very detailed capital and operating cost estimates. And it gives us a very, very high degree of confidence based upon these results that this is a project we now want to accelerate into feasibility and mining lease application programs.
So, give us a summary of the economics of the. Are you putting the foot to the metal? Are you actually going to develop this mine as quickly as you possibly can? And what are the next steps?
So we are definitely pushing the pedal down. We had a suspicion based upon our ongoing work that we've been publishing along the way that we would have pretty material gains in this project. And what we've come to is essentially an initial upfront infrastructure cost of around 350 million Australian dollars, which is fairly modest for a 5 million ton per annum operation. But the key takeaways here is that we are looking at producing nearly 1 million ounces of gold and around 2 million ounces of silver across 8 years. And the way that the economics work, obviously with those bulk open pit economics, is we've pushed our costs up a little bit to be able to go out into a bigger pit. But of course, we have also been the beneficiary of a much, much stronger gold price. So we have now seen the economics of this basically assuming 4 or 5,000 Australian dollar gold, which is about a 25% discount to market price. And these are sort of base case and market price cases. We would be producing between 4 and 5 billion Australian dollars approximately, with a total operating free cash flow, that's revenues, with total operating free cash flow of about 1.8 to 2.7 billion dollars over the course of 8 years. So this gives us a net present value now of around $800 million to 1.4 billion dollars, and an equity IRR before considering any leverage of between 50 and 70%. So very, very compelling economics. And one of the key drivers of these economics is we have a very, very fast payback period. So we have a starter pit that in the first 13 months of operation produces over 200,000 ounces of gold and generates around $700 million in free cash. So very nearly pays back our development costs 2 times over in the first year or so. So we're very excited with the results, of course. And as to the original question, yeah, we are now basically going to be accelerating essentially the long lead mining lease application and PFS program works. So these are things like environmental programs, some selective resource upgrade drilling, all these things that you need to start getting going to sort of then craft the rest of the feasibility and mining lease applications.
And let me ask you, what difference does the high gold price make for you? Has it made it easier in terms of the debt element of the package you're going to have to put together? Just put it all in context for us, please.
Yeah, so the high gold price makes a huge difference, right? And I think one thing that's really important about the study that we've just done is it actually demonstrates the financial and operating leverage that a large scale bulk open pit operation has to either energy savings or to gold price. So you're very, very strongly levered to any upside because you're keeping on a per unit basis your costs quite constrained. Now, even if we had not had a gold price increase, we actually set out in our release publication a comparison with sort of the original initial scoping study results from July of 2024. And then we say, well, what if we simply just put the energy efficiencies into that project to show you taking the effects of the gold price out, how efficient have we made this project? We've increased the NPV by about 25% just on the energy consumption alone. And it actually goes up 40 or 50% once you start factoring all these other things. So gold price aside, we've had a very strong transition from the original to the optimized scoping study. But then the gold price has essentially added about $750 million in gross free cash because everything above your cost of production is, of course, profit.
This hasn't happened by accident, though, Alex. When we met at Master Investor earlier this year, you said that you'd started strategically buying these unloved assets in South Central Australia 5 years ago, 6 years ago, 7 years ago, and that gold price was unloved, South Central Australia was unloved, and strategically you bought.
Correct. Yeah. Look, we had a thesis, um, which went something to the effect of it's 2016. Global credit, whether sovereign or consumer credit, is as bad as it has been, including since immediately prior to the GFC. Monetary policy is the loosest it has ever been. Oh, and by the way, the United States and the United Kingdom have just had two political events which have told the world that they're contracting. And we're going to see essentially increased geopolitical competition. So gold was a pretty easy call in that environment. We could not have foretold things like COVID, which became giant money printing exercises. I think it was quite predictable that Russia would invade Ukraine again, but the United States, rather, let's say, incautious response in terms of actually freezing Russia's U.S. treasuries was, jet fuel on the fire that I think nobody anticipated, because that for the first time broke the modern myth that US treasuries are actually a reserve instrument. Now they're a political instrument. And that really woke up the gold market as people said, wait a minute, if I'm generating, whether it's a billion or 100 or 500 billion dollars in trade surpluses, maybe I don't want to hold so many US treasuries if the US can just slap my hand by freezing the serial numbers. So we were lucky in a sense, unfortunately, in the gold market. Being lucky in the gold market is usually a reflection that somebody else has been very unlucky, and
Mm.
people are quite alarmed. But yeah, we saw overlooked and underpriced assets in a market that was mispriced, that we believe was going to structurally reprice, and now we have definitely seen that. And many of the things that we were talking about, a lot of the things that I was saying on stage 6, 7 years ago, are now sort of in the common discourse. And it's I guess it's nice to be right, but in many respects you sort of go, but I kind of wish we weren't, at least in terms of the thesis behind gold and the geopolitical elements.
And a simple question: if 3,000 is more or less the base level currently, could it go higher? Could it go lower? What are the geopolitical drivers as you see them looking into the future? Given that you looked into your crystal ball and got it right before, what is the
Hmm.
crystal ball saying right now?
Yeah, so on a long-term horizon, I see the gold price considerably higher than it is now. And I'll take a trip into the short-term horizon and say I think we can expect a lot of volatility, right? Because uh, and obviously long and short-term are linked in the fact that the reason why we're seeing this mispricing is that essentially so much of what we take around the world as sort of rote fact, taking around us in terms of financial and capital markets, trade flows, geopolitical alignments, trade and military alliances, and more in a manner of speaking, there has been one world and one general set of rules that has dominated the international space in what we might consider the post World War II NATO, NATO-centric universe, which has been led by and large by the United States and the United Kingdom in sort of a Western liberal democratic partnership. We're now starting to see that unwind. And that was propagated by specifically the US and the UK saying we're pulling back. We aren't quite so interested in this same degree of globalization. We aren't quite so interested in this same degree of cross collaboration. And maybe there's some fair criticisms. We're tired of always having to foot the bill all the time because it became a burden for the UK. It's become a burden for the US. The issue that we now find ourselves in is that we have two things happening. We have essentially this order unwinding, which means that a US dollar denominated global financial system, which has been rapidly inflating to a level, whether in absolute or relative terms, we have never seen in history. We've never had a debt bubble this big. We are now seeing people unwinding their exposure to US instruments. We have a US administration which is telling foreigners to take your money and go home. We are starting to see trade, economic, and military alliances fray and create voids for conflict. But above all and in parallel with this, you've got this geopolitical de-dollarization effect, which, mind you, that's the key thing to me. To de-dollarize anything, gold has to be remonetized. We've had 50 years of gold being pushed to the margins and demonetized. We are now starting to see 50 years of gold compression unravel quickly, and we're starting to see that expansion. I think we've only seen the beginning of it. And on top of all of this, we now have a global sovereign debt crisis that is, for the first time, being honestly and openly talked about as a crisis by even the leading people in the US, the hedge funds and the banks, who have been the prime beneficiaries of this debt bubble. We cannot underestimate the willingness and probability that Western politicians, having discovered they can print money, are going to do this aggressively and for a long period of time, notwithstanding that we all grew up learning what a foolish exercise this was for Zimbabwe. So, Western countries are in a debt trap, and Western countries are ceding the international playing ground, and gold has to be remonetized from a surplus storage standpoint, from a trade standpoint, and as a sovereign risk standpoint to achieve all these things that have to happen. And finally, over the top of those things, the only way for the US to structurally or effectively default on its debt without a hard default and actually encourage investment in the US is to weaken the dollar, kill the sacred cow of the strong US dollar. And because the US dollar gold price is less so now, but will continue to be predominantly set in US dollars, if the US dollar weakens considerably, we will see a very significant move in the US dollar gold price. And effectively, for the first time, I think the US dollar is now starting to float in gold instead of gold floating in US dollars. And I think that's going to accelerate. So that's a very long very long answer. But yes, I think we're actually looking at 20 years of a re-expanding gold bubble. Gold in real terms is still cheap compared to the amount of capital that's been issued and needs to now find a home in the alternative to US denominated instruments.
Okay, I did mention in my introduction you were something of a gold expert, so there you go. I think you've just justified that analysis. Is it too late to play gold? Is the all-time high absolutely the wrong time to invest? What would you advise investors to be looking at? ETFs, physical gold, where to go?
Yeah, so no, I don't think it's too late because I think the decision to invest in gold is one that is about a longer term thesis, right? And whether it's a speculative thesis, whether that's a long thesis or a defensive thesis, right? Whether you're looking to earn money or protect the money that you've already earned to make sure that you can care for you and your family. Fundamentally, looking forward on the fear basis, gold is an excellent sponge for inflation, right? So real assets absorb nominal price expansion. House is worth house and gold is worth gold. So these are good ways to defend your purchasing power over the medium to long-term price horizon. And again, I do think over the medium to long term, we will see gold actually do better nominally and in purchasing power basis than U.S. equities, for example. I think U.S. equities are probably essentially a short pairs trade now with much of the rest of the world as foreign capital cycles out of the maybe not so ever exceptional U.S. equity indices and goes into emerging markets and European markets. But in terms of how you play gold, look, I think that's a question of your risk tolerance, right? So if you move from the physical gold, right? So literally a bar or a coin of gold that you might, keep in a vault or in your safe at home. This is the ultimate zero counterparty risk. Now, if you move house, please do not forget to take your gold out of the walls or, wherever you hid your safe, right? Because this is a common thing you hear from people. But that's the lowest risk component. And as you go into things like equities and then ETFs and then options and futures and types of things, you're essentially adding layers of risk. You're adding layers of participants in the market, and you're adding risk. You're getting farther away from the real product, and you can take your exposures that way, but you have to ask yourself, As I get into more and more elaborate exposures, there are not only more people, but more of them are playing against me. And so for me, the way that I've decided to take this exposure, self-evidently with Barton Gold, is to essentially invest in the physical gold. I've just bought it in the ground, and I have essentially ventured the bet that I will be able to capture that gold cheaply, expand those resources cheaply. Two of those things we have done, and then cross that threshold where I can arbitrage my existing infrastructure to take that gold out of the ground more cheaply than it costs, or than it is worth, rather. And that's really the next step for us. So my personal preference for exposure is in high quality developers. I have built the company that I would have wanted to invest in this regard. So we have built a team that has got hundreds of years of experience finding, permitting, financing, building, and operating major gold assets. So high quality teams with good assets in high quality tier one jurisdictions. I would go risk off on the jurisdiction and focus on high quality teams around decent assets. And that's sort of my exposure.
Okay. The Barton story isn't just about gold. We've had a lot of gold there. Silver has also had a presence throughout all your projects. Silver price is hot right now. Tell us about the stunning silver intersects you've discovered at Tarcoola, which has really set Australia talking, I think. Tell us all.
Yes. This was very interesting. So the Tarcoola, the silver intercept that you're referring to, is at our Tarcoola project. And Tarcoola is an historical gold field. This is actually where South Australia had its high grade gold rush in 1893. So the same year that West Australia had its gold rush, South Australia had its gold rush, no doubt, as somebody was sort of heading west to go to Western Australia. Now, what's interesting is that in this gold field, it's about 15 kilometers long, and we own a mine in the middle of it. But across this gold field, there are about 600 historical high grade mining, small pits and adits and shafts where people were mining 30, 40, 50 grams per ton. That small open pit that's there now, the mine that we own, that was dug in 2016, 17, and 18. But across this 130-year arc of high grade gold production, nobody ever did sort of a modern contemporary interpretation of what are the structures bringing all of this gold to surface and where is it really coming from, and which of these structures are actually the best ones to start focusing around. So while we were building up Tunkillia, we actually did about 3 years worth of work to build a new subsurface architectural model. We published that in November 2023, so about a year and a half ago now. And this gave us essentially, we mapped out about 15 different structures that were parallel and cross-cutting to the one that contains the high-grade open pit that we have there. And then we went and drill tested 5 or 6 of these, and we found high-grade gold everywhere, but one project in particular named Tolmer stood out. And this was actually our favorite target. Now, what we discovered was the gold zone. And then we started drilling and we expanded that. And then we went back and we retested the gold to say, are there other geochemical elements that we can use to predict continuity and use for exploration? And what we found was where we had expected there to be some silver, which you find throughout the gold field, there was actually very high silver. So we had silver grades of 50, 100, 200, 300 grams per ton silver in conjunction with gold of up to sort of 80 grams per ton gold. So this took on kind of a new flavor. And then we stepped off and drilled a subsidiary target about 1 kilometer to the west. And this has essentially become what we're now calling the Western Silver Zone, because our first drill hole drilled one intersection at 6 meters at 4,700 grams per ton from about 46 meters depth. So it's a 28,000 gram meter intersection, which was, I think, the 4th highest in the world on the ASX TSX for the first quarter of this year. So very, very high grade silver. That definitely got people's attention. We put some more drilling into it. We came up with some more intersections that are sort of 5 and 6,000 gram meter intersections. So we've had multiple silver intervals here that have ranked successively in the top 10 drilling intersections reported on the ASX, TSX, and London Stock Exchange. So the funny thing about this, or the odd thing about this, is we have a perfectly two-dimensional understanding of this right now because all of these holes are in one line. So we have literally depth, width, and maybe 15 centimeters of geological knowledge here. What is it? It's very exciting. We're about to expedite a bunch of additional drilling to start drilling further to the west because this is getting thicker and thicker and high grade is continuing to the west. But we're also going to go north and south and give this thing a third dimension and work out what it is. But it looks like it is a high grade silver oxide body of mineralization that may that may overlie, we hope, something that's actually much more interesting in terms of being a large scale gold silver system underneath. So yeah, we got a lot of attention. Certainly, we're very excited by it. It's essentially a third wheel of economics for us and something that we can potentially direct ship to tech producers in Asia.
Okay. Exciting news indeed. Now, my final question, if you could give us a brief summary of the news flow that you expect from Barton over the next 12 months, please, Alex.
Yeah, so the next 12 months for us are essentially the early mining lease application work for Tunkillia, our stage 2 project, and then taking our existing stage 1 platform into operations. So between now and the end of that 12-month arc, we're going to look very, very different. I think we're going to go through quite a transition in terms of who and what we are as a company, and hopefully the valuation of what we're doing. And really, for us, over the next 3 to 4 months, we are going to be again expediting early mining lease application and feasibility work on Tankalia. We are going to be expediting some further drilling on this high grade silver discovery, and we are now, over the course of the next 3 to 4 months, going to come back and finalize a series of resource studies, capex studies, operating studies, to essentially crystallize the story around the who, what, where, when, and why, and how of stage 1 operations, so that around the middle of this year we can tell people this is what we're going to process, this is how we're going to do it, this is what it's going to cost, and this is what we're going to earn. So away we go now on our pathway to 150,000 ounces per annum of production.
Alex, thank you so much for joining us today from Adelaide. There's a huge amount of detail in there. Please do go back through. You'll hear all about gold, hear all about silver. It was very good to catch up with you, Alex. Thank you so much, and thank you for joining us today.
It's always a pleasure. Thank you.